Morning, Market Chameleons. Happy Thursday morning. Thanks for joining, everyone. How are you doing, Dima?
Good morning, Will. How are you?
Great. Let's jump right to the disclaimer.
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. Here's the disclaimer.
Excellent.
And let me share my screen. So I think what we'll do today is Q&A, question and answer day. So anybody has a question out there regarding any of the tools, trades that they've seen, options, something unusual. If you have those questions, there are two ways to do it. You could put them in the chat. Will's monitoring him. He'll read them off to me. Or a better way, I think, to do it, and it's been pretty, I think, good so far, is Will's going to put a link there that you could click on. It'll take you down into the Zoom. When you enter Zoom, you could raise your hand. This way, we could turn you on and hear the question live. You don't have to turn on your video camera, but we'll be able to hear that question. And I think it's just a better way of asking the question, especially when we're dealing with stocks and options, and there are a lot of different surrounding circumstances. So, and you said you're putting in that link, correct?
Yep, link has been popped into the chat. So come on over if you have any questions. Raise your hand or let me know in the YouTube chat that you've come over and you're waiting to go live. So either way, get you on.
Yep. So while we're waiting for some questions to queue up, we're in a little bit of a delay. So while we're waiting for some of the questions to queue up or somebody to come over, raise their hand, we'll just kind of start going over what's going on in the pre-market hours. Take a look at that. There's a couple other things that I could cover in the meantime, but really, this is a chance to kind of get to the questions first. Okay, so let's start out with the pre-market report, and these are stocks that are trading in the pre-market hours. We have the most active list, the biggest percentage gainers, biggest percentage decliners. I'm scrolling down here, looking at the number of companies that made our percentage gainers list. So there are 41 stocks that made our percentage gainers list, 316 that are on the percentage decliners list. So from that perspective, looks like a bearish bias at the open, pretty heavily tilted there, something like 9-1. Let's take a look at the higher market cap stocks, see if we're seeing the same picture there. So I'm going to use this market cap filter, and we'll look at stocks with a market cap of $20 billion or higher. So here, again, kind of the same picture, only 2 stocks made the percentage gainers list, 114 on the percentage decliners list. So from that perspective, looks like right now pretty bearish at the open. Only 2 stocks made there, and it looks like they're reacting to news and earnings. So I seen NVIDIA there reported earnings yesterday after the market closed. That's up 1.4% in the pre-market hours on 607,000 shares. EL also looks like they reported today before the market opens. Before the market opened so far, they're up 1.2% on 15,000 shares trading in the pre-market hours. So there you have that picture here. QQQ, SPY, looks like they're both so far also down in the morning. And I think, what do we have? What is so far the negative news out there? What are you hearing?
I think it was based a lot of it on the Fed minutes yesterday. Right. I think that was a bunch of it.
Yeah, and we're just making new highs as well, so we're pretty up there. A little bit of a sell off is always healthy, but I think the Fed minutes, we got still the Delta variant of the Corona out there. And some what else I was reading, I guess some of the stuff happening in Afghanistan might be spooking people. And certainly there's some negative news out there in China. I know China, their stock market got hit. They're, issuing a lot of new regulations there. So a lot of stuff to look at from that perspective. I'm going to unfilter this. Let me know do you see anything coming in so far, Will?
No questions as of yet. We had Edward. I think it's a long time chameleon just popped up, Edward, and I'm thinking he's the same person, but he was wondering if the chameleon will ever change colors. We ever thought about having the chameleon change colors?
That's what's interesting. Sometimes I get emails with questions and people take snapshots of the chameleon, and so to point like, what is this, or what is that, or can how do you use this feature, can you add something? So I've seen people somehow change the color of it themselves. Like I've seen people who maybe through their browser do a black background, so I've seen people actually, use it and know how to do that themselves by changing that color in the background. I guess you can use your browser to do that, which is pretty cool.
It's funny. I was thinking he was actually meant the logo, our actual chameleons.
Oh, the logo.
Yeah. I don't know. He probably means the site, but I always love the story about how you came up with the name chameleon, which is always a good one. But that's
when I saw that chameleon in my brother's house.
Yeah.
We're like the chameleons because it's constantly adapting and changing.
Yeah, exactly.
So, all right. Well, if there are no questions, maybe what I'll do is kind of move on to a preview of some of the new features that we're working on. And a couple of them will be, I don't think I have it on this version. Oh yeah, there was a question, why does my version look different than your version of the chameleon? So
I think that was maybe on one of the options change. Maybe it was when you were looking at the match MTCH options.
And you might see when I'm going through the menus, or you might see stuff on my version differently. And that's because I'm using an internal version that we use to, test new features, run new types of reports and analytics and studies. So these are things that internally we work on that is not ready for external use. So sometimes when I'm depending on which version I'm on and what I'm testing, what I'm looking at, you might see things, on here that are not yet available, in the external. So there's a possibility it's not available to anybody but me, basically, or anybody working internally.
We did have oh, I'm sorry, B.
Yeah.
We had a big question coming from Albert, who's come on live at least once, maybe twice, and he's gonna come on over and let's see if he's there. Yeah, it looks like he's there. All right. Actually, we have Albert hasn't come on over yet. We do have a question popping up from Mark Langley, which is the first time on. So we'll get Mark, and then we'll have Albert in queue when Mark is done. So Mark's coming on, B, all right?
Okay.
Welcome, Mark. You're on. Just unmute.
Can you hear me, Will?
We can. Thanks for joining, Mark.
Thank you.
Hey, Mark. How's it going?
Oh, great. So Maria, that won your competition and got the mug. The two of us work together. We've been in the financial industry for as long as Dimitri's been alive, I think 35 years. And I just keep seeing questions coming in here. And because this is a community, and because you offer such a great platform, and I see you've got a relationship with Felix at Option Geeks as well. People were asking about option education. Now, there's a broker that is superb. So I won't mention the name unless you give me permission to mention the name.
Sure.
Or if people want to, and we'll use it under the banner of Market Chameleons. And we can have a 1 hour session one day where we just help people and point them in the right direction. And I will make myself available to answer questions and see if we can just help the people within this community, because you talking at a higher level, and it looks like some of the participants in here maybe need a little jump start and some formal education to get to the level where you are actually offering this great service and platform that you have. So I didn't want to have this a long conversation. I'm just making it available. You can do with it what you want, and I'm more than happy to participate with you and just to help those people that need some help.
Hey, Mark, that's a very generous offer. Best thing to do is email Dimitri or myself. Dimitri, you can reach at support@MarketChameleon.com. Now, Mark and Maria, I think you guys are over. I know Maria's in Spain because that's where I sent her the cup. I don't know if it ever arrived.
She's in Portugal, and I'm in the UK.
Yeah. So, and I know they're on every morning and active in the chat. So I'm sure Dee and I would be happy to talk to you, Maria, off air with a chat, and certainly help set something up where you can meet any chameleons who want some help.
And I'll leave it at that. I will send you both emails. I'll copy the two of you and Maria and myself in, and then you can now continue with talking and answering questions about your platform, etc.
Thanks, Mark.
Thank you, Mark.
All right. And we see Mark Albert has stepped up, D, and he had a big 3-part question in the chat.
Okay.
So I figured it's better to bring him on. All right.
Sure. Yep.
Here we go, Albert. Hey, Albert.
Hey, Albert. How's it going?
Pretty good. You guys?
Yep. Pretty good. Thank you.
Great. Thanks. Thanks for coming on again, Albert.
My pleasure. Thanks for having me. I'll reread the question. My question has to do with a theory. No, I need some validation. You probably guessed that I'm in a losing position by my example. My context is option spreads are defined risk trades, whether they are debits or credits, but they are defined risk at expiration, meaning you can theoretically lose more than 100% of your cost before expiration. Is that correct? Is my first assumption correct?
So you're saying you're looking at a vertical spread, from what I understand,
correct,
right? And when you're saying it's a defined risk is because if you're buying an option and you're selling an option, right, you're doing this within the same expiration.
Yes,
I'm assuming. So yes. The way that spread, I'll just queue one up and show you a payout.
The more you can lose is the width of the spread minus your premium or right. your debit.
Right. Exactly. Right. So that right. So this is the spread. So it's the width of the spread, the difference between the strikes. That's theoretically the most that it would be worth at expiration, right? So if you're selling it, and if you did a $5 spread, you're selling it, you might have to buy it back for $5 theoretically, but if you sold it for $2, then you're buying it back for $5, you lose $3. So that's, of course, in theory, that's how it should work. There are other risks involved, like if you have an assignment, early exercise on one of the legs, right? So because you're trading American, and the other is assuming that, you would be able to trade out of it for $5. If the markets are very wide, right? If the markets are very wide, you might not be able to buy back for $5, but theoretically, if they're both in the money, and they're both assigned, that would be the difference between the strikes.
Okay. So the second, so that was my context. The question that I wrote is, if you're in a position losing, I said using, but it was a typo, losing more than 100%, it doesn't make sense to get out of it before expiration, as long as you are well capitalized to weather the storm. Another typo there, weather, to weather the storm. In other words,
You say
you're losing
more than
140% on the spread with 3 days to expiration. You can hold it until expiration to get back to 100% loss, meaning you've recuperated, in quote, 40%. Am I correct with this analysis, or am I missing something that can cost me more dearly, lose more than the 140?
Maybe because I don't quite understand all the circumstances, I'd have to see a picture of what you're looking at, because what you're looking at and what I'm imagining.
You're underwater, D.
Hear me well?
Hey D, sorry about that. I was on mute. You've gone underwater. Your mic picked up a reverb from Al, so you want to log back and come back in. I'll hold Albert on while you do that.
Let me do that. All right.
Hey Albert, thanks again for coming on, my friend. When we get feedback, we'll
Did I express
re-ask the
myself
question.
correctly? Do the other chameleons understand my question?
I think so. Certainly in the chat, it seems like they understood the question. Does everyone seem to understand Albert's question? I'm sorry, I'm back and forth between the chat and listening to you guys. So either way, we can bring it up to D when he comes back. I wanted to thank Mark Langley for coming on and mention it sounds like he and Maria have something going on in the options space. So just email me again, Mark, at williammcbride@gmail.com and Dimitri support@MarketChameleon.com. I will put both those in the chats. Anyone who's new, actually, we had Raj, who's an active user on, and he had a big presentation on the Discord channel, which is another place where chameleons can get together and discuss different features and what they're seeing in the market. And if anyone can email me, williammcbride@gmail.com, and I can send you a link to the Discord if you're not already a member. Has D stepped back in? D, you here?
Yeah. Can you hear me?
Yep,
Yes.
You're good.
All right.
Can you hear me, D?
So, yeah, I could hear you. Albert,
I got a specific example.
Okay.
Target, TGT.
Okay, so let's go to Target.
Tomorrow's 260, 252.50 a bear put.
Okay, so hold on. What expiration?
Tomorrow.
The August 20th expiration. And
Yes.
what are you looking at right now? Which
The
put?
260.
260 put?
The
This one?
260 slash 250, 250 bear put. So I sold.
Buying it? Yeah, you
I
sold
sold the 260 and I bought the 250, 250 put.
it? The 250 put.
252.
Oh,
50.
252 and a half put. This one.
Yeah.
Okay. All right. So this is, so just to, show that this is the spread that you sold, right? And what did it like fall? Was it like above the 260 or something? And then it just went down?
I sold the 260 and I bought the 250, 250. Yeah.
252 and a half. Yeah. 252 and a half put. Okay. So here, right, at this
I'm in the money. I'm in the money on the 250, 250, but I'm out of the money. I'm losing on the 260.
Right. So look, at expiration, right, you got the difference between the strikes, $7.50, right? So that's where you're going to be buying it back at $7.50 because you're going to get at this point, right? You're going to get a sign. Both puts are in the money. So here, these are so deep in the money that if the stock closes here or lower, right, you're going to end up getting a sign on both sides, right? You're going to buy this stock at 260. That's what it's going to look like, and sell it at 252 and a half, losing $7.50, right?
Do I have to do anything? Or is it
I don't
all
think you have
I'm
to do
on the
anything.
IB platform?
I don't think so because they should just offset. You call your broker. I don't want to answer for your broker, but
There is an option in the global configuration. I think your buddy that is in Malaysia who's sick. I think he showed us once where the option was an IB the broker automatically
Yeah, that is Jake, the doctor. That's if I don't know if you've been reading. I know there's a lot going on, Albert, but there's a lot in the chat, and a lot of the chameleons are saying if the spread is a loss, that's just going to be taken.
It will, because they're both deep in the money. To me, I think that they're just both. You don't do anything. It offsets. But call your broker. Make sure, because that's in theory, right? Every broker, I don't know what they're doing there, right? Because you're using a broker, I don't know what they do. Like in theory, you should, if you do nothing, right, both options will go away. You're going to get, and what's going to end up happening is it's going to look like you bought the stock at $260, you sold it out for $252.5, so your position is zero. Obviously, you lost $7.5 on that trade minus whatever you received for it, so that would be the loss. But here's what look, I don't know if you'll be able to get this off, because the market is very wide, 620, 760. Try to buy it, anything right below $7.5, you buy it back. If you think that this is going to keep going down, there's no chance it's going back. It's kind of like, a savings, right? If you could buy it for $7, $6.90, right? You can put in a bid there. Markets are wide. You can put something in between and close out that way. So maybe you'll even get, if you get filled. I mean, I'm just looking here right now at the 252.5 call. It's still bid, right? So you still have premium in the 252.5 call, right? Did they just report earnings?
3 days ago, two days ago, earlier this week, I think. Yeah.
So look, 252.5, right? If it's still premium in there, maybe even the 260. So you still have premium in both calls. You might be able to just trade out of it, buy back that spread for less than $7.5, right?
Mm-hmm.
You be able
would be a smart thing, because obviously I'm making money on the long put because it's below 252.
Right.
I could get out of that leg, take profits, or you would. But if it keeps going down, then obviously
yeah, because now you're putting on a position. Now you're putting on like a long.
Which actually is funny, because I mean everyone's got this is the great thing about trading and the markets.
Everyone's got an opinion, right?
I mean if you read the chat, which I recommend you do when we get off, Albert, there's some good.
Yes, I can't see it. I'm looking at you guys and I'm not reading the chat. But
there's some good insight. Chuck just said you may want to close the buy side and keep this signed until target comes back up. That's his thought.
Again, that's more speculative, right?
Yeah, no, that's exactly what it is.
The safest thing, the safest thing to do is to do nothing, because if I'm losing 140%, and I know that my defined risk is I cannot lose more than 100% theoretically of what.
When you say that, what is 100%? What does that mean?
Well, if the cost of the spread, like you said, is 7.5, let's say it's $7.5 wide. I got a credit of, let's say, $2. So the most I can lose is 7.5 minus the $2, which is $5. So that's a theoretical payout graph when I enter the trade, and that's at expiration.
Right, but if you close it if you close out of it, what I'm saying is, if you want to close out of it before expiration and you feel like it's not coming back, you might be able to do, close out of it for a lower cost than $7.5, right? That's the point.
But if I'm currently losing more than that $5 max theoretical loss based on
why are you saying that?
Why?
Yeah.
Because the payout graph at expiration defines your risk. It's the width of the spreads minus your credit.
Well, your credit you already received, right? That's done, right? It's at this point, you have the spread on, right? And nobody's going to take away that credit. You already received it. But If you wait till if both legs are in the money at expiration, you're buying, think of it this way, at what price am I buying the spread back, right? If I do nothing and both of these are in the money at expiration, you're buying it back essentially at $7.50. But the market is still open, right? So since it's open and you could potentially purchase it back and close out of it for less than $7.50, right? You're buying it back for cheaper, then it's kind of like your loss is less, right? Because you're buying it back, you're closing out, you're done with the spread. So what I'm saying is, if you think that at expiration, the stock is going to be below 252.5, right? If that's what you think it's going to be below 252.5, then this spread will be worth $7.50. But if you could buy back, right? Let's say you could buy back for $6.90, you save 60 cents. Does that make sense?
I think so.
You don't want to pay more than $7.50. You certainly don't want to pay $7.60, right?
Yes, because right now I would be theoretically paying more.
Well, if you paid $7.60, but
my IB in my portfolio, currently it says that position I'm losing 168% of the total. My total cost. I can speak numbers. I have nothing to hide here. I'm losing the cost basis of my position is 5,000, and I'm currently losing 8,000 on it. So, which is 168%. But if I wait till expiration, because of time decay, because I got some theta, I'm collecting theta because it's a credit spread. I'm going to get back down to losing 100%.
No, that's not how it's going to work. I don't think that's so. That's not how it works. So first of all, you're not losing, because when you're saying 160%, your credit, whatever you received in credit, that's not the amount you had at risk, right? That's just the credit. The amount you had at risk was the difference between the strikes and what you received, right? So really, your amount at risk, you sold it at $2, $7.50. That means you're risking $5.50, right? That's the amount you had at risk. So right now, you're not losing 100%. That of the $5.50, you're losing less than that. At expiration, you might lose, if they're both in the money. You have to think about it as the amount at risk, right? The $2 you received, that's not your amount at risk, right? Because you just received the credit. The amount at risk you had is the difference between, your max loss and what you received.
Okay, so it would be in my cost basis if it was a debit spread.
If it was a debit spread, if you paid for it, then yes, then the amount at risk is what you paid, right? Because that's the most you could lose is what you paid for it in a debit, vertical spread. In a credit, it's reversed, right? It's not what you receive, it's the max loss minus what you receive. Okay. So it's the amount you have at risk at expiration. Okay,
I understand.
Right. So if you look at it from that point of view, right, the amount of risk, in this defined strategy, the maximum would be in this situation, if it closed here, right, that's where your maximum risk would be, is both of these are in the money. You get assigned, right, and you bought the spread basically back for $7.50. Right now, it didn't actually, here in this scenario, what I'm looking at, if the stock stays here, right, stays here,
it's around 245.
It's working against you if it stays here. You're not going to earn more money. Nothing's coming back. You're actually going to lose more money than if you could get it at this price, right? At this price. So because remember, now you're in the money, right? It's different than if the spread was
both puts, the price is below both puts. So yes,
exactly. So, right. So now you're not earning decay, you're paying. See your theta? It's negative. That means you're paying every day, right?
I got a credit. It's a credit spread, so I'm collecting more.
Nope. That's not how it works in the vertical spread. It depends where. So it's not the same thing as just selling an option. Even though you receive the credit, you sold an option and you bought an option, right? And it depends where the stock is, because it's below your long strike, right?
I get it. Yeah, I think you explained that to us the other day. It's whichever one is closest to the strike that has the largest amount of decay.
Decay. And right now, even though and that's and I've seen this before where people are just assuming, oh, I received the credit, I'm collecting. That's not true in a vertical spread. That's why when people wanted to, start saying, well, I want to screen by IV and stuff, I think people are confused with these vertical spreads, what's going on. Even though you sold it for credit, but you sold an option, you bought an option. If that stock, if the stock is close to your long strike, you're actually going to be paying. Your position is then paying. You're not earning decay, you're paying decay as you go along.
Yeah,
So the theoretic the theta is relative to where the price is relative to where the price is relative to the strike.
Exactly.
If it's closer to your debit strike, then you're paying theta. If it's closer to your credit strike,
then
you're receiving a credit.
Exactly.
You have to be aware that the theta can change as the stock moves when you have a spread on and if you're taking a credit, that's where you collect your money at the point of the credit, and the theta will change as the stock price moves.
So right now theta is working against you.
Yes.
That's what you're right. You need the stock because you at this point, I'm assuming you didn't hedge anything, then at this point you need the stock. Your best case scenario is that the stock shoots back up, right? Above 260. That's what you really want. But the longer it stays below 252.5, your options, your decay.
I'm hoping for a Vanna rally.
But yeah, so keep that in mind. When you doing a vertical spread, it really depends where the stock is relative to the options and the strikes that you're holding.
Well, listen, the bell went off 3 minutes ago. Albert, great question. It led to an extremely abundant chat. A lot of different ideas coming out of this, simple credit spread. Very interesting, D. Great job, buddy.
Thank you, Will and Dimitri. It just clicked in my head. You clarified something, and I learned a lot. And you just helped me crystallize it in my head.
Well, Albert, and your question helped a lot of other people, so that's great. And D, thanks, Albert. And D, awesome job, baby. Thanks so much.
Thank you. Thanks, everybody. Stay safe out there. Have a good trading day. Hope to see you guys tomorrow.
Great job. Great job. We'll see you tomorrow, everyone. Trade in peace. Bye.
Yep. And thanks, everyone. And thank you, Albert, for the question.